The Greek elections are positive for keeping the euro together. I know there are a lot of challenges ahead still. For all of us as banks, we've got to be prepared for any and every eventuality. But most importantly, what we've been doing is looking at every country on its own. It's like each tub on its bottom. And so when you go to Greece, if you made loans, you want to make sure you get local funding. You have local deposits to cover that. That's called asset liability matching. That reduces your risk. That's what we've been doing for the last 18 months. But one thing we also have been doing is we've noticed that the European banks find it tougher to help some of the multinationals that are headquartered in Europe and they need dollar-based financing. We've been stepping in, providing them trade finance. We've been providing them dollar-based funding that they need to run their businesses around the world, and we're going to continue to do that. You can look at the valuations here around the world, and you can clearly look at the numbers, and there are some compelling values, I'm sure, around the world. But the most important thing, that's Europe as a financial system has almost $40 trillion of assets. And that's compared to $14 trillion in the U.S. banking system. So it's almost 2.5 times the U.S. system. That's big. They're going to have to delever. They're going to have to shrink. And a lot of the activities that are going on in Europe is banks in Europe trying to figure out what they should be doing going forward. It's tougher for them to be in the dollar financing business, and they're also shrinking back a little bit. And earlier this year, we decided that we had to restructure some of our businesses, ready for any eventuality that comes out of here. And so take whatever the worst case is that they have in mind. We're ready for that. And frankly, one of the things that's changed, and I think it's for the better, is money managers and people who own instruments are doing more of their own work. Now, some of that was mandated. Direct mechanical linkage from Moody's advice to a fiduciary action. And I think that's a good thing. We're seeing more and more of that happen. It's not something that's happening uniformly, but we don't expect the impact to be material on us. And when you look at the funding that we've been doing, you're right. A lot of this is completely anticipated. We think it's in the markets. More importantly, as a bank, a big part of our book is funded by deposits around the world. We have over $900 billion of deposits as a company, and that really finances a lot of the activities that we have in terms of lending, which is where you need long-term finance. I don't know the facts on JP Morgan. I can, again, talk to you about what we're doing. And it really revolves around our liquidity portfolio. We have about 400. More importantly, Basel is going to come out with liquidity rules. They haven't finalized them yet, but we're operating as if some of those rules are already in place. And we actually have more liquidity than Basel will require us to do. We've taken a very strong conservative approach to our liquidity pool. In terms of the rest of our balance sheet and how we trade, our derivatives are collateralized. They're risk managed constantly. We have tight risk limits around them, and we're doing them as a accommodation for our clients. 7.2% on Tier 1 Common on Basel III. By the end of the year, we should be over 8%. All of us are waiting to see exactly what the G-SIFI charges are going to be on banks like ours. The minimum number is 7. We're above that. Having said that, we all know we're going to have to. Are not in place until the end of 2018. We'll be there far ahead of that, far ahead of that. But the most important thing to me today is when you look at Basel I, which is today, the operative capital requirement, we're at 12.5%, and we've got over $400 billion. First of all, we've got earnings, and so if by the end of the year we're over 8%, and let's suppose the G-SIFIs require 9.5%, earnings should get us there. Not only that, we've done a great job of reducing Citi Holdings, which used to be 40% of our assets with a lot of capital tied up there. It's now down to 10%. That continues to shed as well. So the combination of Citi Holdings coming down over time and the combination of our earnings profile and our earnings capability should comfortably get us there a lot sooner than 2018. Filed our CCAR submission to the Fed. One of the things we did decide to do is not ask for a return of capital this year. And the reason for that is when you look at the timing, filing now, when we hear back, 2012 is really gone. We're focused on 2013. 2013, by that time, our Tier 1 common and Basel III is over 8%, and we think we're going to be in position to work with the Fed to figure out how to return capital to our shareholders. So we need to make by the end of the year when we file, but certainly not sooner than 2013. I would say is that the Fed did approve certain capital actions, redeeming of our TRUP securities and certain other things that we had in place, but in terms of buying back stock or paying out a dividend, the Fed wanted us to resubmit, and without that action, our stress test results were basically on top of a lot of our peers. And I think the most important thing to us is to make sure we continue to have that dialogue with our regulators, continue to make sure that we keep building our capital strength, keep earning the kind of money that we've been earning in our core businesses. Because ultimately, we and they and everybody else wants to make sure that that we're ready for any eventuality that comes about. Most importantly, we're now focused on 2013. I think 2013 is when we'll file our CCAR, and we'll look forward to that time. We'll work. The emerging markets are still growing. They're growing a little bit slower than they were a few quarters back. Some of that is natural. Some of these economies have grown at a very fast clip for a long time. Countries like we've stepped back a little bit in terms of absolute growth, but the secular growth is there and still strong. For us, we're doing a couple of things. One is that we're banking the emerging market consumer as a bank, but most importantly, we're also banking multinationals, the new multinationals that are coming out of emerging markets, and we're connecting the developed world to the emerging markets as well. When you put all of those things together, we're focused on globalization, we're focused on the rise in emerging markets, and we're focused on the rise in global trade. All those three things we think are very strong trends, and frankly, there's not another bank that can do this as well as we can for our clients. Admitting that the crisis the U.S. went through and some of the things we're seeing around the world are really once in a lifetime, once in a generation, maybe once longer than that kind of events, and these have been substantial events. The other side of that is we have a much stronger financial system in the U.S. Stronger capital, stronger liquidity, recovery and resolution plans that make these banks stronger as well. So I come into this third century as focused around emerging markets, growth in globalization, connecting the world, and as importantly, we're going to be the digital bank going forward. And you know what that means. That means banking anywhere, anyhow you want. And we look at all those things as a very strong path for leading this company into the third century. No, I know there's a lot of work going on. It is a rule that requires a lot of thinking in terms of how you define market making versus proprietary trading. And by the way, we were very supportive of the principle that banks should not be speculating with their capital. Having said that, the details may take a little bit of time.